right, we'll get started here. Thanks for joining us here. Joe from Cycle CPA, and I'm here along with Carla. We are both the co-founders of Cycle CPA, landscaping accountant, and today we're going to be taking a deep dive into fixed assets within your business, things to keep in mind if you're initially purchasing a fixed asset, when it comes to tracking it, and kind of the whole life cycle there. So I'll let Carla take it over to start with some of the details here.
Yeah, thank you everybody for joining. And if anybody has any questions, we'll be taking a few minutes after to answer. So please use the chat option on here to ask any questions along the way. Awesome, let's get started. So what are fixed assets? So in accounting, this has two criteria that it has to meet, right? A company must own or control an asset, and it must be expected to generate future benefit for that company. So, an asset purchase is usually anything over $1,000 that is going to benefit your company for more than 1 year. So, not like a pen, like you're just going to use it today. It's done. But it's more like a truck or machinery, equipment, something that you're going to use for more than 1 year that's going to benefit your business for more than 1 year. And it's typically not easily converted into cash or anything like that. And again, you're going to use it for long term. So, why should you track your fixed assets? So maybe you're looking to sell your company in the future and you want to list those assets and have that on the balance sheet so that the valuation for those assets are taken into account. Taxes, it lowers your tax liability. And who doesn't like that? So something that you should be thinking about, right? Because we're almost heading into the end of the year here. So depending on the asset, it will be depreciated over time. And so that depreciation expense for that asset is tax deductible. But if you're not keeping track of it, there's no way of deducting that, right? Cost savings and better accountability for those assets. Planning for future growth. Are those assets currently on the books still? Do you have the capital needed for asset purchases? And improved accuracy. So when you look at your balance sheet, that's where your assets are listed. You can come up with certain accounting ratios or calculate certain accounting ratios that can help you make those decisions, such as, okay, should you purchase this asset right now? What is my return on this asset? And if you don't have those on the books, then you can't calculate this accurately.
Yeah, and as I'm sure this is something that when you guys are first starting your business, or you're a business that has already been in operation, always kind of whether in landscape or snow business, always looking for potentially that next fixed asset purchase, and taking into account some of the things that go behind that decision, right? Because there's just think about, even if you're considering buying a truck, right? How many different trucks can you purchase, right? There's a lot of, and how many different options when it comes to time period. When should you buy? There's a lot of different factors that go into this strategically to make sure that you're making the best decision based on the business, not based on emotion, not based on what equipment may look nicer than another. So basing these decisions off of the numbers, right? Looking at, potentially how much will this help your production speed? How many hours will be saved based off of that? You also want to look at the purchase price, right? How much will you purchase this fixed asset for? And I put overrated here, right? So it's funny because it is something that you should consider if you are looking to purchase the asset, but there are many other factors to take into consideration, some listed here, some that we'll be going through in the webinar, but that is one of the factors to take into account. How will it affect your bottom line, right? So taking into account net profit, even going as deep into looking at the cash flow, how will the fixed asset affect that? Look at the resale price, right? So you might know how much you're going to be purchasing it for, but if you're going to be purchasing a piece of equipment that's worth $5,000 versus, and then being able to resell that for $2,000 is potentially better than if you were to, purchase something for, a certain price and then not having that resale price associated with this at the end of the life cycle there. So that's definitely something, that may not be obvious up front, but to take into consideration when you're making that decision. Is it prone to breaking down? Not only thinking about those direct costs associated with having to repair it, but also that time lost, right? And the revenue that you could have been making there. And then how fast can you get some of those parts, right? You may be able to find a great deal on a piece of machinery or equipment, but how hard is it to find replacement parts? Is it really hard to train staff on that piece of equipment versus another piece of equipment if you're used to buying a particular brand? Is it smarter to stay within that brand? So taking all of these aspects into account when you're making that decision. And it's important, whether you're the business owner, right, or whether you're head of operations, whether you're in the accounting team, there's, each unit within the business is going to have a particular viewpoint on why a fixed asset should be purchased or why it shouldn't. And as the business owner, it's your job to not only know where each person is coming from, but knowing how to weigh all of those different options, right? So looking into your business, and if you're looking to buy, let's say, a particular zero-turn mower, right? Because your operations guys, the guys working in the field, find that it's a lot easier to use, right? Your senior management may find that, yes, it is more productive, but then you also have your accounting team, right, that has a different perspective and is able to look at things like a forecast or look at the actual profitability of that decision, look at the return on that decision. And taking all this information into account as the business owner, that's when you should be making your decision. Not because your friend down the street got it and it looks awesome. So it's important to take all these things into account.
Great points. Thank you. Okay, so depreciation expense, right? We hear it all the time. What is that? So it's the reduction in the value of the asset with the passage of time due to the normal wear and tear. Again, a truck, you're not just using it, for 1 year, you're using it over, a numerous amount of years. So, to make the calculation easy, let's say that you purchased a $40,000 truck, you're going to use it over 4 years, let's say, within your business. You're going to use it for 4 years. Each year, you're going to put $10,000 towards depreciation expense for expensing it. You're not going to expense the whole $40,000 in the year that you buy it, because this will skew your numbers drastically. It will be counted right in your profit and loss, $40,000. Wow, that's a big expense. It's going to lower your net income so much drastically. But then also, then the next year you won't have that expense, the $40,000, and so your net income will be really high, but like you won't be taking that truck into account. So it's good to be realistic about, okay, what's the useful life of this truck for my particular business when you're posting book depreciation, not tax, right? Tax is different. It has its own rules in regard to depreciation expense. Your tax accountant will see which one is best suited for you. But I'm talking about for managerial accounting purposes, for book purposes, for estimating purposes. Are you going to use that truck, over the next 3 years, 4 years? Are you most likely to keep it for the next 5 years? You're going to depreciate it accordingly. That way you have the correct amount of depreciation expense. So you can take that into account into your estimates as well, right? So this all gives you a better understanding and the true cost of doing business. Again, there's depreciation for tax purposes, and that definitely lowers your net income and therefore lowers your taxes, right? If you're not taking into account any assets, then you'll end up paying more in tax, right? Because you won't have depreciation expense. So it's also important for the valuation of your business. Depreciation in the value of your assets could mean that your business loses value as well, right? And then straight line depreciation, that's the same example that I just went over. So the 40,000 over the 4 years is 10,000 a year. That's the simplest calculation for depreciation expense that you can use. And so the formula would be the value, right? How much you purchased it for, the 40,000, minus the residual value. So if you feel that, once at the end of the life of the asset, if you feel like you can sell it or maybe, trade it in for like $1,000 or so, then you would minus that amount because you would get that amount back, right? And then you would divide that by the useful life. And that's how you'll get your depreciation expense for the year.
Yeah. And Carla, so how would I know that it's 10 years useful life? Is that something that as the business owner, you can determine based on your experience and knowledge of maybe that piece of equipment and how long it will last?
Yeah. So it's going to be different for every business owner, for every business. I know some business owners, they like to purchase new trucks every 3 years, right? But then you may like to purchase a new truck every 5 years. So it's really, the useful life really is going to depend on, like you said, what your what you can forecast it to be. So you could just make that up as you go for certain assets. So maybe you keep mowers for 2 years, 3 years, whatever it is. And so you'll implement that policy within your business so that way you can depreciate certain equipment over a certain amount of years. Yep.
Awesome.
And this is an example of how you post an asset on your books, how to record it on your books. And these are snapshots taken from QuickBooks Online. But these entries, these journal entries will work in any accounting system, right? Because you can create a journal entry in any accounting system. So if you use the same journal entry, it will work, whether you're using Xero or Sage. And so the blue section up here is how to record the asset. So if you go and make a journal entry into your accounting system, and first you have to select the account. So on the number 1 row, I made up an account, a fixed asset account specifically, and I named it truck number 1. And so I debited $30,000 because that's how much I financed it for. That's how much it's worth. I didn't put any money down. I just financed the total amount. So $30,000. And then in row 2, I created a liability account. I called it notes payable for truck 1. And then I credited that liability for $30,000. This would work if you did not, again, there's no down payment. You finance the whole purchase price. In the orange section, I have the end of year depreciation entry. So for this truck, it cost me $30,000. I figured I'm going to use it for 8 years. So the depreciation expense would be $3,750 per year. Per month, if you divide that by 12, you get $312.50 if you want to add this journal entry every month. So the orange is the journal entry to post depreciation expense. So on row number 1, I'm going to choose my depreciation expense account. I'm going to debit that for the yearly entry of $3,750. Again, if you want to do this on a monthly basis, you can use the monthly figure. And then the second row is accumulated depreciation, and I'm going to credit that for the same amount. Now, how do these different journal entries and postings that I just made, how does this look like on my financials? So here in this beige color balance sheet view, you'll see that accumulated depreciation is the negative $3,750. And the reason why that's negative is because it's deducting the $3,750, the depreciation expense, from the $30,000 that the original cost of the truck. If you can see at the bottom, truck 1 was $30,000, but then we're chipping away at that expense, right? Profit and loss view, we have depreciation under other expenses. And we see the expense here, $3,750 for the year.
So that's great to have that depreciation within the profit and loss, because if you're not tracking this, right, then you aren't able to incorporate items like this into your estimating, and thus recouping some of this expense of buying these pieces of equipment. So
yeah, exactly.
That's awesome.
And if anybody wants to know more about how to record this on QuickBooks, or maybe they just want to look at their financials to see if this was ever recorded, please go on YouTube and search Cycle CPA. We have a video up there on depreciation in your business, landscaping business. And I go more in depth into these journal entries and like how it would look on QuickBooks and different items like that.
Awesome. Thanks, Carla. And as we touched on, it's important to make sure that you're tracking these fixed assets, right? Because you want to make sure that when you're coming up with your estimates and your pricing, that you're incorporating not just some of the direct costs, right? Not just the materials and some of the direct labor, but the overhead, and with that, the depreciation expense and everything that is involved with recouping the real expenses that it takes to operate a business. All right. And also, taking it a step further, as you're doing your budget, right? Whether you do a rolling budget throughout the year, whether you're going to be doing the budget for 2022, make sure to incorporate for instance, if you're tracking assets, right, and you know that you're getting close to kind of the useful life of that asset, then you should be building a possible purchase, into, and it may even be in the middle of the year, where you're going to need some of that capital to support that sort of larger purchase. So this is one of the many things to incorporate into a budget or forecast. And I think it's important to I touched on before, based on all those different considerations when it comes to making a decision, right? Because with a lot of decisions within your business, there has to be a process behind, how you came to that result, right? And we want to be able to support it based on numbers. That's really whether your considerations are taking into account other factors. Ultimately, there's one thing that you should always should really be kind of like the common factor is the numbers. So let's take a look at this example, right? You're getting ready for the next season, and you see that there's a particular attachment for your snow business that would cost $4,000, right? You know that there's typically around 19 snow events during the year where you live. This may vary, based on where you live. And you have 40 customers, and that would be 760 visits, right? So 760 times that you had to go to a property to clear snow and ice. And you determine that there's 2 hours per visit. So that's a total of 1,520 hours, right, for that snow season. And you also know that you have a revenue per hour of $120 that you try to build into estimates, right? So through your research, you found that you can upgrade, you can buy this piece of equipment and it will increase your productivity by 10%. Now, is it worth it, right? So this increase in productivity by 10% would open up 152 hours, right? So you do the 0.1 or 10% times the total amount of hours that you are expected to work, which is the 1,520, right? And that's how you come up with the 152 hours that it would save. Now, you already know your revenue per hour, so you multiply that times your revenue per hour, and you find that this one upgrade could actually bring an additional $18,240 in additional revenue to the business, right? And these sort of solid numbers can really show you what your actual return would be on this purchase price of $4,000. Now, $18,000, keep in mind that's your top line, right? That's your revenue. But something that even makes more sense to kind of make this sort of decision is the fact that your field labor and a lot of your variable costs will already be accounted for in the original scenario, right? So you're taking those same amount of hours, but you're increasing the revenue. So what does that mean? A lot of your fixed costs will remain the same, but what will happen is that increase in revenue will actually will have a higher profit margin, right? Because that labor is already paid for. So, looking at, $4,000 purchase price, let's say you're typically at 15% net profit, but because like what I just mentioned, that profit's going to be higher. So you're able to really have a better analysis on, is that piece of equipment does it make sense to make that purchase, right? And in a situation like this, so you always want to take it back to the numbers, right? And base your decisions off of calculations, right? And if you have trouble coming up with any of these numbers, like revenue per hour, for instance, it really all starts with a solid financials, with a solid profit and loss. Because really what it is it's looking at how much overhead you have to recoup, what the direct cost would be. So, we can advise you on some of the back end stuff when it comes to the accounting, but definitely base your decisions off of the numbers. And this is what, if there's one thing to kind of take away from this, is that you can get answers, right, from running scenarios like this. And one of the things to consider, a lot of businesses ran into the issue of they had a lot of work, right? And this could potentially be something that is especially important right now. We know how the labor market is, right? You have to get the same amount of work that you got done last year with maybe less staff. Now, how do you potentially accomplish that? Not necessarily by lowering your overhead. That will be difficult, right? But looking to do some key changes within some of the things that might affect your gross margin, right? So what is one of the big items that would affect that? Your productivity. And now let's talk about some of that equipment, right? So let's take a look at that past scenario, right? We had talked about how this purchase would open up 152 hours. Now, let's just say if we, instead of keeping the labor and having them produce this extra revenue, maybe you don't have the labor. Maybe that's why you make this sort of purchase. So you're actually working less. So there's less hours spent, but you're making, but you're able to sustain a good amount of revenue. So that's a sort of consideration to take into account, especially in these times of labor shortages. And also think about how creative can you get with some of these equipment purchases, and how can you optimize them? And ultimately even focusing on employee retention, because employees that are working on better equipment and getting more work done are typically or are less likely to be fatigued and feel worn down and stuff like that. So all things to consider here. And we'll be as we're talking about these different equipment purchases, for anyone that knows of the GIE Expo, whether you're going for the first time this year, just know that this is a place where you can go check out and even test drive some of the latest equipment. So we'll be there on booth 3024, so you can come and say hi. But this is a great resource. If you're looking to find that piece of equipment that could help increase productivity.
Perfect. All right. So leasing versus buying, what are some of the advantages and disadvantages of both? Leasing is 100% tax deductible. So your lease payments that you're making every month get expensed right away for the whole year. It's great for equipment that needs to be updated frequently. It gives you more flexibility on that end. It's better for immediate cash flow because you don't need to put a down payment with a lot of leases. And so you can just start making your lease payments on a monthly basis. So if you're in a cash flow crunch, but in need of equipment, I would definitely consider leasing for that scenario. And you're able to rotate your machinery every few years to ensure that it's always up to date and working effectively.
Yeah, and guys, if you're looking to either potentially lease or buy a piece of equipment in your business, if you can comment in the chat box, just kind of what is that next major purchase or fixed asset that you're kind of looking to handle, and then also on top of that, if anyone has any questions, like we mentioned in the beginning, feel free to note it down in the chat box.
Yeah. Some of the disadvantages of leasing would be that you can't post the asset on the books because you don't own it technically. Can't claim depreciation expense because it's not an asset. Over the leasing terms, it could be you could end up paying more for it than you would if you were to just finance it or buy it outright. Buying, some of the advantages are you can claim as an asset, so you can have it on your balance sheet and the valuation of your company will increase in regard to that. You can sell it or trade it in at the end of the, life, or, whether you decide to just upgrade. You have complete control over the asset. The negative thing is that it can have a higher upfront cost if you need to make a down payment. And then equipment could get worn out quicker, and you're responsible for damages and any repairs and maintenance. So again, if you're in a cash flow crunch, but feel that if you could buy or lease equipment, it would generate more revenue or make things more efficient, then leasing may be the option for you. But if you're more established, you're not worried about cash flow, you know the business, you know the equipment that you're going to use for numerous amount of years, then I highly would consider just buying it outright. So reconciling loans, and what is that? Again, reconciling loans is like reconciling your checking account at the end of the month. Same concept.
And Carla, I'm sorry, just to hop in here. If anyone isn't familiar with what reconciling is, if you can just give a brief overview of what that typically means. Like let's say for doing the reconciliation of your bank account in QuickBooks.
Oh, reconciling is when you are in QuickBooks or your accounting software, and you are looking at the transactions for that checking, credit card, loan account, and you're matching it to the statement. So your credit card statement, your bank statement, your loan statement every month, and you're matching what the balance says on that statement to what's in your accounting system. So ensuring that those two mirrors is going to ensure that you're not missing any transactions, that things are being posted correctly, nothing is being duplicated or falls through the cracks. So reconciling loans specifically, though, is very important for bookkeeping and tax purposes. And we don't see many businesses doing this. Even the larger businesses are not doing this. And reconciling on a monthly basis to that loan statement, like I stated before, because you want to separate principal and interest every month. The reason why you want to do that is because interest expense then goes on your profit and loss, and you're able to take that as a tax deduction, right?
So Carla, and just to kind of break this down even further, this is just one of the many expenses and examples of why sometimes people may think that they're estimating correctly and taking all the expenses into account, but it's items like this that really may be kind of missing. So
yeah, like typically, interest expense could be anywhere from 2 to 5% of income, so of revenue. So, missing out on the interest expense on your profit and loss means you're missing out on a line item for overhead costs, and you're not taking that into consideration when it comes to estimating, correct? And down here, you can just see posting of a loan to your books. So here I am debiting the fixed asset account called truck for $40,000 because that's the purchase price. Owner's investment, I'm crediting for $10,000 because that's how much I put down. And then the note payable is what the financing amount, which is the rest, the $30,000. So that makes up the 40. So you'll categorize your loan payments. So that $500 that gets deducted from your account on a monthly basis, you'll put that towards notes payable, and that will decrease the liability every month as you pay it off, right? But you also have to separate interest from that $500, right? Within that $500 payment, you have principal, a part of that payment that's principal, let's say $400, and $100 towards interest, let's say. It really depends on the interest rate. And so you're able to separate that out by looking at your loan statement that you receive every month, let's say from Wells Fargo. It tells you this is how much you paid towards principal. This is how much you paid towards interest. You separate that out on your accounting system. When you separate it out, then you see the interest expense reflected on your profit and loss statement. And so you're able to take that tax deduction. You're able to take that into account into overhead when you're estimating. And so it works both ways. Again, I have a YouTube video on this and where I go further into depth if anybody wants more details.
Thank you, Carla. So, now we're looking at, loans, right? Why do businesses and, Gerard, I see you're looking to get a new truck and trailer, right? For the next season. So whether you're looking to make your first purchase, whether you're looking to add to your current model, it's always something to kind of look at. Is it, should I be doing this with a loan? Should I be doing it, purchasing it, the whole purchase price? One thing to know is that you can usually grow faster, right? When you're utilizing loans, right? Because think about it, you may not have the money to purchase a truck, all cash, right? So, and even if you do have the money, that's something where maybe it's not worth for you to tie up more capital than you have to into buying a fixed asset like a truck. So and why I say you can grow faster, because the reality of the situation is if you have $30,000, you can potentially buy 2 trucks, and over time with the 2 loans, and have 2 crews going, versus tying up all your cash and having 1 crew going, right? You will have to make those monthly payments, but the return on the money that you put in is greater if you're using the loans. Also know that there's another side to this that you should be aware of, and that there's something called being over leveraged, which means that, and you may have, if you're in real estate, you may hear it too, but it becomes dangerous, right? If you do have a lot of loans within your business and you are making a lot of monthly payments, because if something happens, God forbid, and the business isn't flowing in like it usually does, you're still going to have to be paying those monthly payments. So you want to make that decision, right? As I mentioned before, as the business owner, taking all of these items into account. Some people believe you should only buy everything all cash and, stuff like that, which is fantastic, right? And you can do that and it'll work. And, but there's other people that will argue the complete opposite, right? Because there may be a fantastic opportunity that comes along, right? We're going into the next snow season. you may see someone in a Facebook group, in the landscaping accounting group, that says, I want to sell all my snow clients tomorrow. Oh man, I just bought a truck. I can't, I can't buy those, those customers. So there's a lot of value associated, and even the term cash is king, right? There's a lot of value associated with being able to have your capital, right? And typically, the cash flow also improves if you're utilizing loans. And as I mentioned, the return is typically higher. And again, I'll bring it back to real estate in a way that is, you can kind of, I think it helps to kind of break it down more. If you were to buy a property for $200,000 all cash, and let's say you were renting it out, it's great that you're getting, let's say, $1,000 from the property every month, but your return is $1,000 per month times 12. That's $12,000. You're looking at approximately a 6% return on your money. Now, what happens if you instead, take out a mortgage, right? Even with that monthly payment, maybe you only have to put, let's say, $50,000 down, right? But you get, let's say, $500 a month, right? Which equals around $6,000. And then that return, is ultimately higher than if you were to put the all cash. Now, not that you had to follow along with all the specific numbers, but it's important to understand the idea behind why businesses use loans, and the term leverage, right? So it's not almost using loans as a crowbar, right? Using it to, let's say, open a door with just the same amount of energy as if you were to try to open it with your hand, but you're using almost like a tool, right? Use loans as a tool to be able to grow your business, even grow potentially faster. And like I said, some people might have different views on, I've seen some people say, even within the green industry, people say you should buy all cash, you should do that. But definitely, one of the main takeaways is, just know that, your capital and cash is a valuable thing. So, make decisions to, definitely keep that in mind. And it's also important to know that money, right? So if you're looking to purchase a new truck, which we're going to go into a specific example, but just know that money, if you are using a loan, let's say, that remaining money can be used to actually get you more of a return on your investment or your money, because at the end of the day, that's what your business is, right? It's an investment. The reason that you didn't, that you're not in another business is because you hope to have high profits, or else you would put your money somewhere else, in some sort of safer investment. Now, here's an example of, and in this specific example, we're considering replacing a truck, right? So you're not going to be buying an additional truck. You're going to be replacing a truck that really, it's just, you had to just get rid of it. You couldn't sell for that much. You just had to, you had to do what you had to do. So in the scenario one, you decided to purchase it all cash. So you had, let's say, $70,000 in the bank. You purchased the truck for $30,000, right? So you pretty much, it was an all cash deal there. So now you have scenario two, right? So purchase price of $30,000. Let's say you had a down payment of $6,000, right? Which is, and now you have that difference, right? You have that difference of $24,000 that you can work with, right? That capital is still with the company. Now, let's say you don't even, use up all of it. You keep some aside for maybe some of those future payments and some other items within the business. But you take $20,000, right? You use it to invest into your business, whether it's through advertising, sales, getting some more administrative support, which can open up your time more to then get more business in, right? So even if you don't believe in paid advertising or things like that, there are other ways to utilize that money to help to build. But in this specific example, we're talking about actually using that money for, let's say, paid advertising, right? And you're able to use that money to get 70 additional lawn maintenance accounts. So those are reoccurring accounts, which ultimately comes up to, let's say, 150,000 revenue per year, reoccurring. And you also figure that you make approximately 15% net profit margin, right? So potentially bringing in, $22,000 additional net profit into the business. Now, also taking it even more detailed, that net profit of 1,875 per month, right? So it's a 22,500 divided by 12. That's how I got the monthly. So that's what you would get in net profit per month, approximately. Even after minusing the potential truck payment that you'll have to make, right? Because you only put 6,000 down, you're still left with net 1,375 per month. So this is, some of these numbers may vary drastically, right, based on what you decide to do with your money. But this is an example of why, especially if you don't have a ton of money, why you should be very strategic about how you utilize your money, right? And you also want to ensure, kind of playing devil's advocate to this, that, for instance, in today's market, yes, it's okay to put 6,000 down, but don't make that decision when you can't necessarily afford to do the $500 a month truck payment. So, because what happens, especially in today's times, you can get those additional accounts, right? You can plan that, yes, I can go out and get all these accounts, but what's going to happen? Then other factors come into play. Do you have field employees now to actually work on those 70 accounts? Because if you don't, then you're not going to be net positive. You're going to be making those $500 payments. So it's important to, when you're making this decision, to try to think of all of those different aspects that will have to align in order to make this work. But I hope the one takeaway that you get from this example is that when you hear someone say you should purchase it all cash, that's very broad. You should really think about it and base it off of the numbers, right? Just like the other example when we were talking about that attachment. Always try to bring it and simplify it, right? If people try to get too detailed about things, it'll never end good. Just try to simplify it as much as you can. Base it off of your knowledge, your experience, and then that should help you reach the best answer there.
Thank you. So another thing to take into consideration is cash flow and forecasting your cash flow. So what is your cash flow? It's what you will have at the end of each month in your bank account, right? So you can forecast this out. And I did go over how you can do this on Excel, again, on our YouTube channel. You can find it there. But basically, you'll want to create a cash flow forecast for the next couple of months. So that way you can see where it's most beneficial for you to make an equipment purchase if you need to pull a down payment from that checking account, or maybe if you're even looking to see if you can afford a monthly payment. You plug that into your forecast, and then you're able to see what you're left over with at the end of the day and whether that's feasible or not. You can pull up, even if you don't make a cash flow forecast, pull up your profit and loss statement for past months, so historical months, and see where your revenue is much higher in certain months, where your net income is much higher, in conjunction with pulling up your cash flow statements in your accounting system for the past months. Where is your cash flow higher? Which months are higher historically? Which months are lower? And maybe that will help you make a decision as to which months you should, pull that down payment for that asset purchase. Also taking into account, cash flow will help you so that way you're not in a cash flow crunch, like I said. Because of the seasonality of the business, you want to pull up that historical data to see month by month the history of where your cash flow has been during certain months, right? So in an example here, so let's say you would like to purchase 2 trucks for this upcoming snow season, each having a purchase price of $30,000. Where would you buy? If you purchase early, will you have field staff ready for both trucks? What is the strategy and moving parts around the decision? So if you're going to purchase 2 new trucks, at the end of the day, those trucks need to be generating revenue for you, right? Positive cash flow. And so you can't just say, okay, I'm just going to buy a new truck, right? You need to strategize behind that. Am I going to buy a new truck and add on 2 more workers? And those 2 workers can generate, $80,000 each on average a month. Okay. How can they generate more revenue? Do I need to now increase my advertising budget because now I have more mobility and I can go and make more estimates and, generate more revenue that way? So that way I can make sure that this truck is, being of use to my company. There needs to be a strategy behind the decision of purchasing assets rather than just wanting the shiny new toy on the block, right?
Yeah, and just to piggyback off of your point there, Carla, like for instance, even looking here, one may say, we can definitely purchase at least 1 as early as October, right? But like you mentioned, Carla, it takes time to get maybe those extra accounts, right, where that truck will be utilized. Is it better to potentially optimize or, let's say, maximize the amount of work that's already be done that's based off of the equipment that you have, waiting until you have a little bit more accounts to absorb some more of that asset purchase? So maybe it would make sense to do the first purchase in, let's say, November, and then maybe the one after that in December, right? So there's a lot of different factors to consider there.
Yep. So purchasing fixed assets could be a tax saving strategy for your business. So let's say that, you should be able to generate a profit and loss for January through August at least, or I hope you're able to do that. But basically, let's say that you're looking at January through August and you realize that your net income is very high, right? And so what are some ways to decrease that net income so that you don't end up paying a lot of taxes? One way is by purchasing an asset. So if you purchase a truck, equipment, machinery before December 31st, then you'll be able to claim that on your taxes and have that depreciation expense write off. you can, depreciate it all in one shot or over in amount of years that you're able to do that for tax purposes. And something that you want to consider is like, yes, this will lower my tax liability. You want to know how much it's going to lower your tax liability, but also, will this affect your emergency fund? So are you pulling out a down payment for that asset that will affect that emergency fund, your cash flow? Because you don't want to be left with a little bit of cash flow, because then you don't have that cushion. Unless you finance the whole asset, right? Then obviously there would be no down payment, therefore not affecting your cash flow that drastically, except for that monthly payment. So things to consider here. And it's always better to lower your tax liability, for the current year at the end of the day, right? So,
because cash is king.
So we have some fixed asset ratios and KPIs that you can calculate for your business. And all of these could be calculated by looking at your balance sheet and your profit and loss statement. So the first one is called return on assets. And so it's your net profit or your net income. Divide that by your total assets. And so if I get a high number, a high percentage here, then that means that I'm using my assets effectively, I'm using it efficiently. That means that my assets are generating net income for my company, which is a good thing, right?
Yeah, and almost similar to kind of what we were going over before. Ultimately looking at, where is your money best spent, right? And in this specific ratio, it's telling you that, if your net profit is high versus the amount of assets that you have, that you are using your assets very efficiently, and bringing you, a
net profit.
Yeah. So
yeah.
Thanks, Paul.
If this percentage is low, that means that you may not be using your assets as efficiently or effectively, or there may be something else going on with your assets or net profit, right? Your next ratio that you'll want to calculate is asset newness. It calculates how new your assets are. So this can help you in determining if it's too early or whether you should purchase new assets. So you have your denominator here, which is gross, fixed, and non-current assets. So gross fixed assets is the asset purchase price before depreciation expense. So just the purchase price, what you purchased it for, right? And then the numerator here is net fixed assets. Purchase price minus depreciation expense. So this percentage tells you, how new your assets are. So if this percentage is high, then that's telling you that your assets are newer, right? So when you depreciate your truck, let's say you have a truck that you've depreciated, and you've had that truck for 5 years and the useful life is 6 years, then this ratio will tell you, okay, now it's time to purchase a new asset, because depreciation expense is being considered in the numerator, net fixed assets.
Yeah. So to me, this is a good ratio to look at maybe when you're budgeting for the next year, because it shows you, all right, how new are my assets right now, and
Yeah.
is this going to be a year where I'm going to have to make more than normal, fixed asset purchases?
Right. Exactly. Asset turnover is total sales, so top line revenue, divided by total assets. Again, it's it's measuring how much sales your assets generate within your business. So the higher this percentage is, the better. The more that your assets are generating sales for you, right? The lower it is, could be an indicator that you're not using your assets as effectively or efficiently, or there may be something going on with sales, right? So those are 3 fixed asset ratios that you can calculate using your profit and loss and your balance sheet. It's going to tell you things like effectiveness of the assets, efficiencies of the assets, and then whether you should be looking to purchase new assets, how new your assets are.
Yeah, we talked a lot about, buying, leasing equipment, when it comes to fixed assets. But keep in mind that, it may sometimes make sense to rent some equipment, whether you're just starting your business and testing out a certain service line, or you have an established business and you're looking to, try a different type of service that requires a different piece of equipment, and you don't maybe know if you want to do that long term, but you're testing it out. Typically if you use the equipment, if you don't use it on a regular basis, then it may be more worth to rent. And again, you can run the numbers on this, right? If you were to buy versus rent, if you know that you have a certain amount of those projects per year that you will be using that piece of equipment, you can figure your exact profitability on it versus if you decided to rent it. And when it comes to renting, one of the advantages is that you only need to pay for what you use, right? So if you only use it for a day, that's what you pay for. Now it'll be obviously more than if you were to buy it. Using it for that day, it's not cheap, but it's better than paying it for a longer period of time when you don't need it for all of that extended time. You may not have to really deal with the maintenance and equipment issues during the life cycle of the piece of equipment. But just know that, and again, another issue that you may run into is, is that piece of equipment available? So you may not want to risk that sort of thing, right? If you tell the customer that you're going to be at a property at a specific time. Just know that there is the possibility of, renting as well.
Perfect. Thanks, Joe. If anybody has any questions, feel free to type it into the chat box. But again, if you want to ask me something specifically in regard to anything else, accounting and bookkeeping related, again, we do anything from bookkeeping to CFO level services, and we are specialized in the landscape industry. Feel free to visit our group on Facebook called Landscaping Accountant. We post on there every day. We post videos and blogs and little tips and tricks for the green industry.
Yeah, and there's some of our previous webinars in our YouTube channel, Cycle CPA.
Yeah.
So we just did one a couple weeks ago, and there's some on there for financial statement analysis, job costing, all different sorts of fun stuff. And this webinar will be emailed to you as well. So you can have it for your record. That way you can look at some of the calculations and some of the items to take into account. And as Carla mentioned, we do anything from, the bookkeeping all the way to CFO services. If you have any questions, here you can reach out to us. But it doesn't really look like anyone really has any questions as we're wrapping it up here. So hope everyone has a great night.
All right. Thank you. Thank you everybody for joining, and have a nice night. Bye.